Imagine you're launching a corner coffee shop today. You sit down with your lawyer, and without even a second thought, they're going to put your new business into a limited liability company, right? An LLC.
Oh, absolutely. It's the default.
Right. But now, I mean, imagine you are this master of the universe launching a $50 billion private equity fund. You sit down with the most expensive lawyers in Manhattan, and they wouldn't touch an LLC with a 10-foot pole.
Yeah, they'd run the other way.
Exactly.
Hmm.
In fact, they will intentionally put your new massive fund into a corporate structure that is older, significantly clunkier, and honestly, infinitely more dangerous.
It's wild. It really is.
So why does the smartest money in the world actively reject the most modern, flexible business structure we have?
I mean, it feels like a glitch in the matrix, doesn't it? We all just operate on this assumption that the wealthiest institutions have access to the most advanced legal technology.
Right, the cutting edge.
Exactly. And for everyday entrepreneurs, the LLC really is the pinnacle of legal tech. But, when you move into the realm of high finance, the calculus just completely flips. Suddenly, the very things that make an LLC brilliant become, well, radioactive.
Radioactive, wow. And that radioactive paradox is exactly what we are navigating today. So, welcome to the deep dive. Our mission today is to unravel a massive, multi-trillion-dollar mystery in the world of high finance and corporate law.
It's a big one.
It really is, because if you are an ambitious founder listening right now, or maybe you're just insanely curious about how the actual plumbing of the global economy works, you have probably wondered why every major investment fund uses a limited partnership, an LP, instead of an LLC.
Yeah, and to crack this code today, we're relying on an incredibly comprehensive source. We are looking at a highly detailed legal memorandum. It's written by Viacheslav Kutuzov, Esquire, dated April 2026.
It's a brand new piece of analysis.
Exactly. And this document, it's essentially a masterclass in the comparative legal architecture of business entities. It takes us deep into the actual machinery of general partnerships, limited partnerships, and LLCs.
And it exposes exactly why Wall Street stubbornly refuses to upgrade its operating system.
Refuses to, yeah.
Okay, so let's unpack this. Because before we can truly understand why Wall Street loves the old school LP so much, we kind of have to look backward, right? We need to understand the evolution of these business entities.
Right, the history is everything here.
Specifically, we need to understand the fatal flaw that the LLC was actually invented to solve in the first place. So I read in the Kutuzov memo that the oldest, most foundational form of a business is the general partnership, the GP.
The granddaddy of them all, yeah.
Yeah. And what blew my mind is that you don't even need to file paperwork with the state to accidentally create one. How does that even happen?
Well, the law actually recognizes a general partnership completely organically. Under the Uniform Partnership Act, a GP arises by default whenever two or more people just, carry on as co-owners of a business for profit.
So no forms, no fees.
No formal state filing required. You don't need a complex charter. If you and I decide to buy a lawnmower together today and start charging the neighbors to cut their grass.
And we split the profits.
And we split the profits, yeah. Congratulations, we are legally a general partnership.
That's crazy. It's just an aggregate of people doing business. It sounds wonderfully simple, honestly, like just shaking hands on a porch.
It is simple.
But the memo makes it sound absolutely terrifying. It mentions something called joint and several liability. Walk me through what that actually means if things go wrong.
Oh, think of it as the ultimate financial exposure. In a general partnership, every single partner is 100% personally liable for the obligations of the firm.
Wait, 100%?
Yes, and for the actions of the other partners. So let's take our lawn care business, right? Suppose I am driving our company truck to a job. I get distracted looking at my phone, and I crash the truck into a luxury storefront.
Oh, boy.
Right? Causing, let's say, $2 million in damage and injuries.
And our little lawnmower business definitely does not have $2 million in the bank.
Far from it.
Yeah.
So, because we are a general partnership, the injured parties don't just sue the business. They sue us personally.
Both of us.
Both of us. And because of that joint and several liability rule, they don't have to politely split the bill between us.
Right.
If my bank account is totally empty, they can come after you for the entire $2 million.
Are you serious?
Oh, absolutely.
Yeah.
They can take your house, your personal savings, your investment portfolio. You are entirely on the hook for a mistake I made, simply because we decided to be partners.
That is horrifying.
It gets worse. Every partner is a general agent of the firm. That means I could go out tomorrow and sign a disastrous, crippling 5-year contract with a fertilizer supplier without even telling you.
And I'm stuck with it.
You are personally bound by it, yes.
So a GP is basically a three-legged race, where if your partner trips, you both break your nose.
That's a perfect way to put it.
You are just entirely at the mercy of the worst decision your partner might make on any given Tuesday. I mean, that sounds completely unworkable for anything larger than a neighborhood lemonade stand.
Right, and that's exactly why the law eventually had to invent something safer. That extreme personal exposure is what necessitated the evolution of the limited partnership, the LP.
Okay, so the LP comes onto the scene.
Yeah, it was designed as a statutory compromise to encourage people to invest capital without risking their personal ruin. It takes the partnership concept and splits the owners into two entirely distinct classes.
Okay, break down those two classes for me.
So on one side, you have the general partner. The GP is the person or the entity that actually runs the day-to-day operations. They make the decisions, they hire people, they sign the contracts.
But they still have that liability, right?
Exactly. Because they have all the power, they still carry that traditional unlimited personal liability. If the LP gets sued into oblivion, the general partner goes down with the ship.
That sounds like a terrible job. Why would anyone volunteer to be the GP?
Well, because they get to control the capital of the second class of owners, the limited partners.
Ah, money people.
Exactly. The LPs are the passive investors. They put up the money, and in exchange for that money, the law grants them a liability shield. Their personal assets are completely protected.
So if the company goes bankrupt?
The most an LP can lose is just the money they originally put in. Their house is safe.
But I'm guessing that shield comes with some strings attached, right?
A massive string. A
Yeah.
very thick rope, actually. To keep that liability shield, the limited partners must strictly adhere to what is historically called the control rule.
The control rule.
Right. They must remain entirely passive. They are legally forbidden from participating in the day-to-day management of the business.
I see. So the investors are basically sitting in the back seat, completely blindfolded, and they are legally forbidden from touching the steering wheel.
Not even a pinky finger on the wheel.
Because if they do reach up and grab the wheel, what happens to them?
If an LP steps over that line, say they start negotiating contracts or maybe hiring employees or aggressively dictating strategy, a judge will look at them and say, well, you are no longer acting like a limited partner.
You're acting like a general partner.
Exactly. And poof, their liability shield just vanishes. They become personally liable for the firm's debts, just like the GP.
That seems like a massive catch-22 for an investor.
Oh, it really is.
You put your millions in, but if you see the manager driving the company straight off a cliff, your only choices are to sit quietly and lose your entire investment, or try to stop them and risk losing your entire personal net worth.
It creates an incredibly tense dynamic. Investors obviously hated having to choose between protecting their personal assets and protecting their active investments.
I bet.
And that tension, that inherent structural flaw in the LP, is what paved the way for the ultimate modern innovation. The limited liability company. The LLC.
The LLC. The Kutuzov memo makes it sound like the absolute holy grail of corporate law. It essentially takes the best parts of the GP and the best parts of the LP and just throws away the bad parts, right?
That is the perfect way to describe it. The LLC was totally revolutionary because it fundamentally decoupled liability from management.
It coupled them.
Right. It provides a universal liability shield for all of its owners, who are called members, by the way, regardless of how active or passive they are.
So earlier I used the three-legged race analogy for the GP. The LLC then is like everyone getting their own padded bumper car.
I love that. Yes.
If the business crashes into a wall, the LLC takes the damage, but your actual physical body, your personal bank account, is completely protected by the bumper car. And unlike the LP, you don't lose your bumper car just because you decide to grab the steering wheel.
Precisely the point. You can have what's called a member-managed LLC, which operates very much like a general partnership, where everyone votes on everything, everyone hustles, but everyone retains their liability shield.
Okay, so total freedom.
Total freedom. Or you can set it up as a manager-managed LLC, where the passive investors appoint one person to run things, which looks a lot like an LP.
But with a safety net.
Right, because the beauty is, if an investor in a manager-managed LLC suddenly needs to step in and fire the manager or veto a genuinely bad decision, they don't forfeit their liability protection. The shield is absolute.
I did notice in the memo, though, that getting this incredible bumper car isn't quite as simple as shaking hands on a porch. You actually have to formally ask the state for permission.
Yes, you do. Because limited liability is a privilege granted by the state, and LLC just like an LP actually, is a creature of statute. You absolutely must file formal documents.
Like the Articles of Organization?
Right, usually called Articles of Organization or a Certificate of Formation, and that goes to the Secretary of State.
And the memo points out a totally bizarre quirk about these filings, specifically in New York. Kutuzov brings up something called the publication requirement for New York LLCs and LPs. I read this section and legitimately thought it was a typo.
Oh, it's not a typo, though it certainly feels like a practical joke played on modern businesses.
It really does.
When you form an LLC or an LP in New York, the law mandates that you must publish a formal notice of your entity's formation in 2 separate newspapers.
2 newspapers.
Yes, which are specifically designated by the county clerk.
Yeah.
And you have to run these ads for 6 consecutive weeks.
6 weeks.
And then you have to file an affidavit with the state proving you actually did it.
6 weeks of print newspaper ads for a tech startup in 2026.
Yep.
Kutuzov notes that if you are forming your business in New York City, this newspaper ad requirement can cost you between $1,500 and $2,500. Why does this even exist anymore?
It is a pure historical anachronism. I mean, think back to the 19th century, before the internet, before easily searchable state databases. Public notices in print media were really the only reliable way to inform local creditors that a new limited liability entity was operating in their neighborhood.
So it was a warning system for the milkman or whatever?
Exactly, a warning system. Today, of course, it operates as nothing more than a bizarre barrier to entry for small businesses, and frankly, a state-mandated subsidy for local print newspapers.
A subsidy, wow.
But it remains a strict legal requirement.
That is just wild. But okay, minor anachronisms aside, looking at the structural evolution, the LLC seems flawless. It gives you the flexibility of a general partnership with the bulletproof protection of a corporation.
On paper, yes.
So we arrive right back at our massive, multi-trillion-dollar paradox. If the LLC is the perfect bumper car, why wouldn't everyone, especially most sophisticated private equity firms and hedge funds on Wall Street, just use it? Why hasn't the LP gone extinct?
To find that answer, we have to pull back the curtain on a much darker, much more complex arena. We have to look at how these entities interact with the Internal Revenue Service.
The tax labyrinth.
Yeah.
Because as Kutuzov so brilliantly lays out in the memo, the LLC's greatest strength, its ultimate flexibility, actually transforms into its biggest weakness the very moment you involve the IRS.
It really does.
But before we get into the weeds here, I want to clear up a massive misconception. I hear founders all the time say, it doesn't matter if I use an LLC or an LP because they are all just pass-through entities and they are taxed exactly the same way.
That is a wildly prevalent and deeply, deeply flawed assumption.
So it's just wrong.
It stems from a kernel of truth. It is true that GPs, LPs, and LLCs are all generally treated as partnerships for federal income tax purposes.
Okay, so what does that mean practically?
It means the entity itself does not pay a corporate-level income tax. Instead, the profits and the losses kind of pass through the entity directly to the individual owners.
Right.
And then those owners report that income on their personal tax returns.
Right. They all file that big informational return, the Form 1065, and they hand out a Schedule K-1 to every investor at the end of the year.
Exactly. So from 30,000 feet, looking only at the paperwork they file, they appear identical.
Yeah.
But the Kutuzov memo systematically dismantles the idea that they're actually tax equivalent.
Okay, let's get into it then.
As soon as you look at the actual mechanics of how different types of taxes are calculated, the LLC and the LP diverge dramatically.
Let's start with the tax issue that hits people the hardest on a day-to-day cash flow basis. The memo spends a lot of time on something called SECA.
Yes, SECA.
That acronym was just alphabet soup to me when I read it. What is SECA and why is it so terrifying?
Well, SECA stands for the Self-Employment Contributions Act.
Okay.
Most people understand payroll taxes, right? When you work a normal W-2 job, your employer withholds Social Security and Medicare taxes directly from your paycheck.
Right. You never even see that money.
Exactly. SECA is simply the self-employed version of that exact system. It imposes a combined tax of 15.3% on your net earnings from self-employment.
15.3%. That is a massive chunk of change to lose before you even pay your regular state and federal income taxes.
It is incredibly burdensome. Now, let's look at how that 15.3% tax applies to our 3 business structures.
Okay.
In a general partnership, the IRS takes a very blunt approach. The entire share of the profits allocated to every single general partner, is automatically classified as net earnings from self-employment.
Wow, so if our little lawn care GP makes 100 grand in profit, we are getting slammed with that 15.3% hit on all of it, no questions asked.
No escape hatch whatsoever, you just pay it.
Ouch.
But when we look at the limited partnership, we find a massive explicit loophole written directly into the tax code. There is a specific statutory exception under Section 1402A13, specifically for limited partners.
Wait, an explicit exception?
Yes, the code explicitly excludes the profits allocated to a limited partner from being hit with the SECA tax.
Let me make sure I'm following this perfectly. The general partner of an LP, the one actively running the fund, pays the 15.3% because they're actively working.
Correct.
But the limited partners, the passive investors who just put up the money, they take their profits completely free of that self-employment tax.
That is correct. Because the LP statute strictly forbids limited partners from participating in management, the IRS accepts that their income is purely a return on passive investment capital.
Like a stock dividend.
Exactly like a dividend, rather than earnings from their own labor. So they bypass the Senley tax entirely.
That is a staggering financial advantage for the LP structure. So what happens when we look at our perfect modern LLC? Since an LLC is also taxed as partnership, do the members get that same amazing LLC exemption?
And this is where the incredible flexibility of the LLC creates absolute chaos.
Oh, no.
Remember, the core feature of the LLC is that a member can be completely passive one day and then actively step in to manage the business the next day, all without losing their liability shield.
Right, the bumper car lets you grab the wheel.
Furthermore, state law doesn't formally label them as a limited partner. The statute just calls them members.
So the IRS looks at an LLC member and says, well, we have no idea if you are working your tail off or just sitting on a beach in Cabo, so we don't know how to tax you.
That is the exact dilemma. The IRS absolutely craves bright lines. They want to easily categorize you as active or passive. The LP structure hands them a bright line on a silver platter.
And the LLC refuses to give them one.
Exactly. Back in 1997, the Treasury Department recognized this mess, and they actually issued proposed regulations to try to create a test for LLC members.
Okay, what was the test?
They basically suggested that if an LLC member worked fewer than 500 hours a year in the business, and importantly, didn't have the authority to sign contracts, they could be treated conceptually like a limited partner and avoid the SECA tax.
Oh, so they tried to invent a workaround to fix the flexibility problem. Did it work?
No, because those 1997 proposed regulations were met with massive political pushback, and they were never officially finalized.
Never finalized. So what are they now?
They've just been sitting in a state of suspended animation for decades. As a result, LLC members live in a state of constant ambiguity. And lately, the IRS has stopped waiting around and has become very aggressive during audits.
Aggressive how?
Their default position is often to challenge LLC members and demand the 15.3% tax unless the member can definitively prove they are practically invisible in the business.
Wait, hold on. You're telling me that because the LLC is so wonderfully flexible, because it doesn't force people into rigid, archaic legal buckets, the IRS basically throws its hands up and says, you don't fit our neat little boxes, so we're going to punish you with higher taxes.
Yes.
The flexibility itself is literally the tax liability.
It is the ultimate irony of tax law. The tax code craves certainty. The LLC provides operational flexibility, but at the direct cost of tax certainty.
Wow.
If you were structuring a multi-million-dollar enterprise where a 15.3% tax swing could cost your investors an absolute fortune, you don't want ambiguity. The planning calculus heavily favors the rigid, predictable LP form.
And according to the memo, the IRS isn't just going after LLCs anymore. Kutuzov highlights a massive tax court case from 2023 that seems to be shaking the very foundation of the LP world, too. It's called the Sorobin Capital Partners case. What is happening there?
The Sorobin case is a huge wake-up call for the entire private fund industry. For decades, highly paid lawyers operated under a very comfortable assumption. If the state paperwork said you were a limited partner in an LP, the IRS would just blindly accept that label and give you the SECA tax exemption.
A paper shield.
It was a paper shield. But in Sorobin, the IRS argued, and the tax court actually agreed, that they are no longer going to just look at the label on the door.
They are looking past the paperwork to see what the person is actually doing in real life. The memo calls this a functional analysis, right?
Yes, functional analysis. The court ruled that if a person legally titled as a limited partner is actually out there hustling, directing investment strategy, and performing vital active services for the fund, they are not acting as a limited partner as such.
As such.
Right. They're functioning as an active manager. And if they function as an active manager, they must pay the SECA tax on their earnings, regardless of what the state charter says.
So the days of slapping the title limited partner on a hedge fund manager who works 80 hours a week just to dodge payroll taxes are coming to an end.
Very much so.
That is a massive shift. But SECA isn't the only place the LLC stumbles, is it? There is a highly technical section in the memo about how these entities borrow money and deduct losses.
Yes.
Kutuzov calls it outside basis in Section 752. I really want to break this down because it sounds absolutely critical for anything involving heavy debt, like a real estate fund.
Oh, it is arguably the most critical tax component for the entire real estate industry.
Okay, let's unpack it.
To understand it, we need to quickly define what outside basis actually is. In partnership tax law, your outside basis is basically a rolling tally of your economic investment in the entity.
A scoreboard of your money in the game.
Exactly. And it is incredibly important for one main reason. You are legally forbidden from deducting business losses on your personal tax return that exceed your outside basis.
Okay, so if my basis goes down to zero, I hit a brick wall. Even if the business is generating massive paper losses, like, say, depreciation on a skyscraper, I can't use those losses to lower my personal tax bill anymore.
Precisely. You're cut off. And for real estate investors, those depreciation deductions are the absolute lifeblood of their strategy.
Right.
Now, the tax code under Section 752 allows you to artificially increase your outside basis when the partnership takes on debt.
Okay, that sounds like a good thing.
It is, but, and this is the crucial pivot, the rules for how that debt increases your basis depend entirely on whether the loan is recourse or non-recourse.
Okay, let's define those terms for the listener. Recourse debt means the bank can come after a human being if the business defaults. Someone has personally guaranteed the loan. Non-recourse debt means the bank can only foreclose on the specific collateral, like repossessing the office building itself, but they can't go after anyone's personal bank account.
A perfect summary. Now, let's look at how the LP handles a recourse loan. Because the general partner has unlimited personal liability, the tax code looks at a recourse loan and says, well, the general partner bears the ultimate economic risk of loss here.
Because their house is on the line.
Right. Therefore, the general partner gets to add the entire amount of that recourse debt to their own outside basis.
Giving them a massive reservoir of basis to absorb all those juicy tax deductions.
Exactly. But what about our beloved LLC?
Oh boy, here it comes.
This is where the bumper car crashes hard into the tax code. Remember, the defining feature of the LLC is the universal liability shield.
Right, nobody is personally liable.
Because absolutely nobody in an LLC is personally liable for the entity's debts, the IRS views almost all LLC debt as non-recourse by default.
Wait, really? Even if the bank thinks it's a standard business loan, the IRS says it's non-recourse because of the LLC shield?
Yes. The IRS says no one bears the economic risk, and non-recourse debt is allocated among the owners using a phenomenally complex three-tier waterfall system under the Treasury regulations.
I saw that in the memo. It looked like calculus.
It is brutal. And without dragging us through the agonizing math of that waterfall, the practical result is often disastrous for the LLC members. They frequently end up being allocated far less basis than they would have received if the exact same business had been structured as an LP.
So let me paint a picture to make sure I grasp the real-world gravity of this.
Please do.
Imagine a group of investors pool $100 million to buy a giant office park in Austin, Texas. They take out heavy loans to leverage the deal. If they use an LLC, the IRS forces them to treat the debt as non-recourse.
Correct.
Because of that complex math, their basis is artificially low. Year after year, the building generates massive paper losses through depreciation. In an LP, the general partner could soak up those losses and save millions on their personal tax bill. But in the LLC, the members hit that zero basis brick wall early. The deductions are just trapped inside the LLC. They lose the tax benefit entirely.
That is exactly the scenario that keeps real estate tax attorneys up at night, staring at the ceiling. The very thing that makes the LLC attractive, the fact that nobody is personally on the hook, structurally limits the member's ability to utilize tax losses.
The protection inherently chokes off the deduction.
Exactly.
It is stunning how every time the LLC tries to protect its members, the IRS finds a way to penalize them for it. Are there any other hidden traps in the tax code for LLCs?
Oh, there's another big one. One of the most frustrating for everyday founders is what practitioners call the W-2 trap.
The W-2 trap.
It is governed by a very old piece of IRS guidance from 1969, Revenue Ruling 69-184. The rule is absolute. A partner cannot be an employee of their own partnership for federal employment tax purposes.
Wait, what? If I start an LLC tomorrow and I am a member of that LLC, I can't just put myself on the company payroll and get a W-2 like a normal employee?
You absolutely cannot. The IRS views you strictly as an owner, never an employee. Any money you take out of the business for your services has to be classified as a guaranteed payment or as a draw against your distributive share of profits.
I mean, cash is cash, right?
Mm-hmm.
Does it really matter what piece of paper the IRS uses to report it?
It matters immensely when you try to set up benefits.
Oh, right. Benefit.
The entire modern corporate benefit structure is built conceptually around the W-2 employee. If you don't have a W-2, you generally cannot participate in the company's cafeteria plans for health insurance on a pre-tax basis.
Oh.
You face massive complications trying to participate in standard group health coverage. And the rules around participating in qualified retirement plans like 401ks are distinctly different and often much less favorable for self-employed owners.
So a startup founder puts their company in an LLC, they go out and hire a great software engineer, they set up a slick health insurance and 401k package for the new hire, and then they realize they can't actually participate in their own company's benefit plan.
Exactly. Or if they do, it's a tax nightmare. It creates immense administrative friction. Kutuzov notes that if LLC founders desperately want to be treated as W-2 employees, they have to engage in ridiculous legal gymnastics.
Like what?
They have to set up a totally separate corporate management entity just to employ themselves, or they have to make a special tax election to be treated as an S corporation, which comes with its own nightmare of rigid ownership restrictions. It is never simple.
Friction. Friction seems to be the defining word for the LLC in the tax realm.
It really is.
And I noticed the memo didn't just stop at the federal level. We have been focused on the IRS, where everyone files Form 1065. But Kutuzov highlights that state governments are actively weaponizing their tax codes against LLCs as well.
State taxation of pass-through entities is a wildly inconsistent patchwork across the country. But several major states have looked at the explosion of LLCs and decided, hey, they are a fantastic source of targeted revenue.
Like a piggy bank?
Right. They impose entity-level taxes on LLCs that explicitly do not apply to general partnerships, and sometimes spare LPs as well.
I read the section on California, and my jaw literally dropped. How bad is the California tax hit?
It is exceptionally punitive for high-revenue businesses. California imposes an annual gross receipts fee on LLCs doing business in the state. And it is vital to note that this fee is based on gross receipts, not net profit.
Oh, man. So even if your business is operating at a massive loss, if money is just flowing through the cash register, you pay.
You pay. On top of a standard $800 minimum tax just to exist, this gross receipts fee scales up to a maximum of $11,790 per year.
Nearly $12,000 a year just for the privilege of existing as an LLC in California. Even if you are bleeding money, that is wild.
And California isn't alone. Tennessee hits LLCs and LPs with franchise and excise taxes that general partnerships somehow avoid. New York City has the unincorporated business tax, which casts a wide net over partnerships and LLCs.
Though, to your point earlier about high finance getting special treatment, Kutuzov does note a fascinating carve-out in New York City. Entities engaged solely in trade and securities for their own account are exempt from the unincorporated business tax.
A nice little gift for the Wall Street hedge funds.
Unbelievable.
Indeed. But the broader takeaway from the state and federal tax landscape is clear. The LLC is absolutely not a tax haven. When you combine the SA tax ambiguity, the Section 752 basis limitations on debt, the W-2 employee benefit trap, and aggressive state-level gross receipts taxes, the LLC is just swimming in tax friction.
Okay. I am thoroughly convinced that the LLC is a massive tax headache.
Yeah.
But here's where I still struggle with the central paradox of this whole deep dive. Let's say you are a titan of Wall Street raising a $20 billion buyout fund. You have an army of the best accountants and tax lawyers on the planet.
The very best.
Surely they can navigate the tax friction, right?
Mm.
They can map out the debt basis. They can structure around the W-2 trap. To understand the true, absolute dominance of the LP in elite finance, it feels like we need to look beyond just the tax code.
We do.
We need to look at the psychology and the ironclad regulations governing the investors themselves.
That is the essential pivot. The tax code is merely the perimeter defense here. To find the core reason Wall Street rejects the LLC, we have to examine the rigid architecture of the LP and why institutional investors desperately demand that rigidity.
Okay, before we dive into that architecture, I want to clarify something for the listener based on a note in the memo. When we talk about investment funds using LPs, we are not talking about the mutual funds sitting in a normal person's 401k.
Right. That is a critical distinction to make. If you log into your Vanguard or Fidelity account right now and buy shares of a retail mutual fund, you are almost certainly not investing in a partnership.
Right.
Those retail funds are regulated under the Investment Company Act of 1940. They are typically structured as Maryland corporations or Delaware statutory trusts, and they use a special tax regime called Subchapter M to avoid corporate taxes.
Because sending a 50-page Schedule K-1 partnership tax form to 2 million everyday retail investors would cause a national administrative meltdown.
Precisely. It would be a disaster. Mutual funds are built for mass retail consumption. When we talk about the dominance of the partnership structure, we're talking exclusively about the elite private sandbox.
The big leagues.
We are talking about hedge funds, private equity, and venture capital. These funds rely on strict legal exemptions, specifically Regulation D and certain sections of the 1940 Act, which require them to limit their investor base to incredibly wealthy individuals and massive institutional pools of capital.
We're talking sovereign wealth funds, university endowments, state pension plans.
Exactly.
And in this exclusive sandbox, Kutuzov argues that the LP's defining structural feature, the very thing that makes it seem archaic and dangerous compared to the LLC, is actually its ultimate superpower. He calls it the wall.
Yes, the wall. The hard statutory wall separating the active general partner from the passive limited partners. As we discussed in the beginning, the LP statute legally disables the limited partners from participating in management.
Right, if they touch the steering wheel, they lose their liability shield. Now, here's where my mind rebelled when reading the memo. You would logically assume that an institutional investor putting $500 million into a venture capital fund would want maximum flexibility.
You'd think so.
You would think they would say, hey, we are giving you $500 million. If you start making terrible investments, we want the right to step in, fire the manager, and take over the portfolio. An LLC would allow them to do exactly that without risking their liability shield.
Right. It gives them the option.
But Kutuzov claims that neither the manager nor the investors actually want that power. I don't buy that. Why wouldn't a massive sovereign wealth fund want the option to intervene?
Let's look at it from both sides of the table, starting with the fund manager. The manager, acting as the GP, wants absolute dictatorial control over the capital.
Right, it's their vision.
They have a specific investment thesis. They do not want 50 different institutional investors, each with their own internal politics and investment committees, second-guessing every single trade or demanding a vote on when to sell a specific portfolio company.
Okay, from the manager's perspective, I get it. The manager wants to be a dictator. If they used a member-managed LLC or even an LLC with blurry voting rights, an activist investor could easily find a legal loophole to justify interfering.
Exactly. The manager wants to point to the rigid LP statute and say, read the law. You are a limited partner. You have zero voice in management. Sit down, be quiet, and wait for your returns.
So the manager weaponizes the LP's rigidity to maintain absolute control.
They do. But the true paradox here is that the institutional investors, the pension funds, and the endowments are entirely aligned with this. They actively want to be legally gagged and blindfolded.
But why? Why would you willingly give up the right to protect your own $500 million investment?
Because the moment an institutional investor possesses the legal ability to manage or control a business, they trigger a cascade of catastrophic regulatory frameworks.
Catastrophic how?
We are talking about massive federal laws like the Bank Holding Company Act, the Investment Advisors Act, and the Volcker Rule.
Okay, walk me through a concrete example. How does a regulation like the Volcker Rule suddenly ruin a bank's day if they invest in an LLC instead of an LP?
Let's say a major global bank invests in a private equity fund. That private equity fund then buys a controlling stake in a national chain of pizza restaurants.
Okay, pizza.
The Volcker Rule and banking regulations place severe restrictions on banks owning or controlling non-financial commercial businesses. If the fund is structured as an LLC, where the management boundaries are fluid and members can legally intervene, a federal banking regulator might look at that structure and say,
Right, let me guess. The regulator says the bank has the potential ability to influence this fund. Therefore, the bank is secretly exercising control over a pizza chain.
Exactly. And suddenly the bank is facing massive fines, cross-liability issues, and a compliance nightmare because the regulator thinks they are illegally running a pizza empire.
Oh, wow. So the institutional investor wants to avoid even the appearance of control.
Exactly. The statutory passivity of the limited partnership is the ultimate defense mechanism. When the regulator comes knocking, the bank's lawyers simply hold up the Delaware LP statute and say, look at the black-letter law. Our client is a limited partner. It is a legal impossibility for them to exert control over the fund or its assets.
The rigidity of the LP is literally a regulatory force field.
A force field, that's a great way to put it.
That makes perfect sense. The LP structure perfectly mirrors the economic reality. One party has the brains and the hustle, and the other party just has the giant pile of money and wants to be left completely alone.
Right.
But there's one specific regulatory monster mentioned in the memo that seems even scarier than the banking rules. Kutuzov spends a lot of time on ERISA. What is ERISA, and why does it dictate corporate structures?
ERISA stands for the Employee Retirement Income Security Act of 1974. It is the federal law that governs private pension plans in the United States. And it is arguably the most demanding, unforgiving regulatory regime in all of finance.
Unforgiving?
Oh, absolutely. When a ERISA-regulated pension plan invests its retirees' money into a private fund, there's a massive legal danger. If the fund isn't structured perfectly, the Department of Labor might decide that the underlying investments of the fund, say, the stock of a startup company, are legally considered plan assets of the pension fund itself.
And if the startup stock is suddenly classified as a plan asset of the pension, what happens to the private fund manager?
The fund manager is instantly transformed into an ERISA fiduciary.
Is that bad?
It's a death sentence for a typical private equity business model. Under ERISA, a fiduciary is held to impossibly strict standard. They are subject to prohibited transaction rules that effectively make it illegal for the manager to compensate themselves normally or to engage in standard financial transactions.
Oh, wow. So how do funds avoid triggering this ERISA death sentence?
There are a few escape hatches. A fund can simply refuse to take too much pension money, staying below a 25% threshold.
But funds want that pension money. It's trillions of dollars.
Exactly. So if a fund wants to take unlimited pension capital, they usually have to qualify as a venture capital operating company, or a VCOC.
A VCOC. And to get that magical VCOC status, what does the fund have to do?
The fund itself must obtain and actively exercise direct management rights over the portfolio companies it invests in. It can't just be a passive holder of stock. The fund manager has to sit on the board of the startup and actively direct its management.
Okay, I think I see where the LLC problem arises here.
You probably do. When an ERISA attorney is writing a legal opinion to assure the Department of Labor that a fund qualifies as a VCOC, they have to prove that the management rights are being exercised exclusively by the fund manager.
And absolutely not by the pension plan investors.
Correct. In a limited partnership, the locus of management power is completely unambiguous. The statute says only the general partner manages. The analysis is clean and easy for the lawyers.
But if the fund is an LLC, the Department of Labor regulator looks at it and says, wait a minute. An LLC is inherently flexible. Any member could theoretically step up and exercise management rights. How do I know the pension fund isn't secretly the one managing the startup company?
Exactly. The inherent flexibility of the LLC creates a diffuse, murky analysis. The ERISA Council has a much harder time writing a clean, unqualified legal opinion because the boundaries of control are porous.
The LP's rigidity is precisely calibrated to satisfy the paranoid demands of federal regulators.
Exactly.
Okay, I am completely sold. The LP gives the manager dictatorial control, it protects the passive investors from the 15.3% SECA tax, and it builds an impenetrable regulatory force field to protect institutional investors from banking laws and ERISA nightmares. It sounds like the perfect machine.
It is a perfect machine.
Except, wait, hold on. I am remembering the very first thing we discussed today, the fatal flaw of the entire partnership concept. The general partner of an LP has unlimited joint and several personal liability.
Yes, they do.
We are talking about hedge fund managers who are billionaires. Why would a billionaire manager ever agree to put their personal yacht, their mansions, and their children's trust funds on the line just to give their investors a clean ERISA structure? It makes absolutely no sense that they would take on that risk.
It wouldn't make sense. And the reality is, they absolutely do not take on that risk.
They don't.
No modern fund manager operates with naked personal liability. And this brings us to what I consider the most elegant piece of legal engineering in the entire financial sector. Kutuzov outlines exactly how the lawyers solve the manager liability problem.
I have been calling this the master hack in my head, the Russian nesting doll solution. Tell me how Wall Street neutralized the only real weakness of the limited partnership.
They neutralize the general partner's liability by making the general partner an LLC.
Wait, just put an LLC inside the LP? You can do that?
You absolutely can. A legal entity can act as a partner. The human fund manager does not act as the general partner in their own individual capacity. The typical structure of a modern private equity or hedge fund actually comprises three distinct interlocking entities.
Okay, break down the three entities for me.
First, you have the fund itself. This is the big bucket that holds the investor's money and buys the assets. This entity is organized as a classic Delaware limited partnership.
Okay, that makes sense. The fund is an LP, so it gets the SECA tax breaks and the ERISA regulatory force field for the investors.
Precisely. Second, you have the general partner. The LP requires a general partner to run it. But instead of a human being, the lawyers create a single-purpose Delaware LLC.
The shell company.
Exactly. The human manager owns and controls this new LLC, and this LLC signs the paperwork to become the general partner of the fund.
Let me make sure I fully grasp the genius of this. The LLC steps into the role of the general partner. Under the law, the general partner takes on the unlimited liability of the entire fund. But because the general partner is an LLC, its liability is strictly limited to its own assets.
That's it, exactly.
And I'm guessing this shell LLC has basically zero assets in its bank account.
Exactly. It is a shell designed entirely to absorb liability like a sponge. If the fund gets sued for $1 billion, the plaintiffs sue the fund and they sue the general partner.
But the general partner is just an empty LLC.
Right. The human manager pulling the strings from behind the LLC is completely shielded. Their yacht and their mansions are safe.
That is incredible. A total cheat code. And you mentioned a third entity.
Yes. The third entity is typically the management company. This is yet another separate Delaware LLC.
What does that one do?
This is the actual operating business. It employs the analysts, it signs the lease for the fancy office in Manhattan, it pays the electric bill, it provides advisory services to the fund based on a management contract.
So keeping the operating business separate from the general partner entity adds yet another layer of liability insulation.
Yes, it isolates the risk even further.
So the lawyers literally just nested these entities together like matryoshka dolls. They built the outer shell as an LP to harvest all the regulatory and tax benefits, but then they embedded an LLC inside the cockpit to protect the human pilot.
It's beautiful, isn't it?
It really is a legal cheat code. But it makes me wonder, if the LLC was mature enough to use as the GP, why didn't anyone just invent a whole new unified entity? Like, why keep this patched together Frankenstein monster of an LP and an LLC?
That leads us to the critical concept of global alignment. High finance does not operate solely within the borders of the United States.
Right, it's a global game.
Institutional quality funds are aggressively seeking capital from all over the globe. They want money from U.S. taxable billionaires, U.S. tax-exempt university endowments, European pension funds, and sovereign wealth funds from the Middle East and Asia.
And all of those different investors have wildly different tax profiles and home country regulations. How do you build one fund to handle all of them?
Well, you don't build one fund. You build a master feeder structure. This is the backbone of global alternative investments. The lawyers set up a massive central hub called the master fund. This is the entity that actually goes out and buys the startup companies or trades the stocks.
And where does this master fund live?
Almost always in a tax-neutral offshore jurisdiction, most famously the Cayman Islands. It is organized as a Cayman Islands Exempted Limited Partnership, or an ELP.
Okay, so the master fund is in the Caymans. Where do the feeder funds come in?
The feeder funds act as funnels. You set up a U.S. feeder fund, typically a Delaware LP, specifically to pool money from U.S. investors.
Okay.
Then you set up an offshore feeder fund, perhaps another Cayman ELP, to pool money from European and Asian investors. Both of these feeder funds then dump all their capital down into the Cayman Master Fund.
And here is where I see the brilliance of the Delaware LP coming into play. The memo mentions that the Cayman Islands didn't just accidentally create a partnership structure.
Far from it. The Cayman Islands legislative body intentionally designed their exempted limited partnership statute to mirror the Delaware Limited Partnership Act almost line for line. It is a deliberate, highly engineered copy.
So the U.S. feeder fund is a Delaware LP. The offshore master fund is a Cayman ELP. Legally speaking, they are identical twins separated at birth, just operating in different countries.
Exactly. And the financial benefit of this twin structure is staggering. It means that the high-priced law firms structuring these megasons can use the exact same legal vocabulary globally.
Right, same contracts.
They can use the exact same subscription agreements, the same side letters, and the same fundamental partnership logic for an investor in New York as they do for an investor in Dubai. They don't have to invent a bespoke legal framework for the offshore entities.
This standardization must save tens of millions of dollars in legal friction and drafting risk. Now, imagine the alternative universe where Wall Street tried to force the LLC to be the standard. What happens if they try to use our perfect U.S. bumper car in a global master feeder structure?
The entire global alignment shatters. The U.S. LLC has no true line-for-line equivalent in the Cayman Islands. But even more disastrously, foreign tax authorities do not consistently respect the U.S. LLC as a pass-through entity.
Oh, the Canadian trap. The Kutuzov memo specifically highlights this massive blind spot. How does Canada view our modern LLC?
The Canada Revenue Agency, the CRA, generally treats all U.S. LLCs as corporations, regardless of the fact that the IRS treats them as pass-through partnerships.
Oh, wow. So if a massive Ontario teachers' pension fund decides to invest in a U.S. private equity fund structured as an LLC, they are walking into a trap.
A huge trap.
The IRS looks at the LLC and says, this is a partnership, pass the profits through. But Canada looks at the exact same entity and says, no, this is a foreign corporation paying dividends.
Yes. And that entity classification mismatch is financially disastrous. It routinely destroys the benefits intended by the Canada-United States Tax Convention.
Wow.
The distributions flowing to the Canadian Pension Fund may be subject to severe double taxation or highly unfavorable dividend treatment under Canadian law. It necessitates incredibly complex and expensive workaround structures to fix.
So from a global perspective, an LLC is essentially toxic if you want to seamlessly raise money from Canada or integrate efficiently with Cayman structures.
Toxic is a good word for it.
The limited partnership, on the other hand, is universally recognized internationally as a fiscally transparent pass-through entity. The LP literally speaks the global language of finance.
And speaking of language, there is another profound reason the Delaware LP remains the undisputed dialect of corporate law. It has to do with what happens when investors get angry and sue the manager.
Litigation.
The memo delves into the depth of fiduciary duty precedent.
Right. Kutuzov points out that both Delaware LPs and Delaware LLCs offer an amazing feature for managers. The statutes allow the founders to draft a contract that aggressively modifies or even completely eliminates traditional fiduciary duties.
Correct. Under both the Delaware LP Act and the Delaware LLC Act, you can write an operating agreement that says the manager owes no duty of loyalty to the investors, subject only to a very narrow implied contractual covenant of good faith and fair dealing.
So this allows a manager to legally invest in competing businesses or engage in self-dealing transactions without getting sued for breach of fiduciary duty.
Basically, yes.
But if both the LP and the LLC allow you to eliminate these duties, why does the LP have the advantage?
Because of the depth of the case law. The Delaware LP has a massive historical head start in the courts. Kutuzov lists several landmark cases.
Right, like in re-USA Tefe's Gotham Partners, Brinkerhoff versus Enbridge Energy.
Exactly. That body of jurisprudence from the Delaware Court of Chancery and the Delaware Supreme Court is decades older and significantly more granular than anything available for the LLC.
So they've already hashed out all the arguments in court.
Exactly. Those judicial decisions collectively delineate the exact, predictable boundaries of the law. They tell lawyers precisely how to structure safe harbors for self-dealing, exactly what language will effectively waive a conflict of interest, and what narrow remedies are actually left for limited partners if things go wrong.
So if you are a fund manager and you are asking investors to hand over $10 billion under a contract that explicitly says, I am allowed to act in my own self-interest.
You do not want to test novel legal theories.
Right. You don't want to be the guinea pig in an unprecedented LLC lawsuit where a judge might decide to interpret a clause differently.
You want absolute predictability. The LLC case equivalents are far fewer in number and much more recent. Investors and managers demand the old, well-worn path. They know exactly how a Delaware Chancery judge will read an LP agreement. They possess slightly less certainty when it comes to an LLC operating agreement.
Which brings us, perfectly, to the final and perhaps most profoundly human reason why the LP reigns supreme, and why the LLC will likely never conquer Wall Street. It's about inertia, isn't it?
Yes. The Kutuzov's memo refers to it as path dependence.
Path dependence. Institutional familiarity. It is the concept of friction that we discussed earlier, applied to the scale of the entire global financial system.
You have to remember the timeline here. Hedge funds and private equity firms largely adopted the limited partnership form in the mid to late 20th century. The legal architecture was built, tested, and optimized long before the LLC even existed as a viable alternative.
Because the IRS didn't even formally bless the LLC structure until a Wyoming revenue ruling in 1988.
Right.
And then the famous check-the-box regulations didn't happen until 1996.
Exactly. By the time the LLC grew up and became viable, the LP had already conquered the world. The concrete had fully set.
Wow.
The entire global financial ecosystem was built natively on the LP chassis. Think about the infrastructure of a massive sovereign wealth fund or a state pension system. Their internal legal departments, their due diligence checklists, their multi-million-dollar compliance software systems, their accounting back offices, they are all literally hard-coded to process limited partnerships.
So boil this down for me. Are you genuinely saying that a multi-trillion-dollar global industry relies on an older, clunkier corporate structure, partly just because institutional investors are set in their ways and don't want to update the column headers on their due diligence spreadsheets?
Well, I mean, it sounds absurd when you reduce it to a spreadsheet joke, but it is fundamentally true.
That's crazy.
In the world of high finance, deviation creates friction. Friction creates delay. And delay kills deals. The Kutuzov memo specifically points to the documentation standardization driven by the Institutional Limited Partners Association, or ILPA.
Right, ILPA. They are basically the trade group that publishes the industry rulebook for how these funds should behave.
Exactly. ILPA publishes extensive model provisions and template terms for the limited partnership agreement, the LPA. Every serious player in the industry knows the geography of an LPA.
Like the back of your hand.
Yes. They inherently understand how a distribution waterfall is supposed to function within an LP framework. They know the exact mechanics of a general partner clawback, and they understand what legally constitutes a key person event.
So imagine a hotshot manager brings a slick, modern LLC structured fund to the investment committee of a massive endowment. The committee doesn't say, oh, wow, what an innovative legal structure.
No, they say, why does your operating agreement look different than the 50 LPAs we reviewed this morning?
Exactly. Manager suddenly has to go on the defensive.
They have to spend precious time explaining the legal deviation. They have to hire expensive lawyers to translate standard LP concepts into LLC vocabulary just to assure the investors that the economics are the same.
If you substitute an LLC operating agreement, you are practically begging the investors to reopen negotiations on points that were otherwise completely settled by decades of industry norms.
Exactly. When you standardize the legal plumbing, you can focus all of your brainpower and your legal budget on the actual investments rather than arguing over definitions.
And there is one more massive piece of path dependence that serves as the ultimate engine of this whole industry. The memo touches on carried interest.
Oh, yes.
For the listener, carried interest is the famous performance fee that fund managers charge. It's usually 20% of the profits. It is how billionaires are minted on Wall Street.
Yes. Carried interest is structured legally as a profits interest in the partnership. Under long-standing IRS guidelines, receiving a profits interest in exchange for providing your services as a manager is generally not a taxable event upon receipt.
It's the absolute holy grail of tax planning. You get a contractual right to 20% of the future upside of a billion-dollar fund, but you don't have to pay income tax on the value of that contract on the day you sign it.
Right. You only pay tax years later when the fund actually sells a company for a profit.
But the rules surrounding carried interest are incredibly dense and fragile now, right? Especially after the Tax Cuts and Jobs Act of 2017.
Yes. That legislation created Code Section 10L61. It imposes a strict requirement. Fund managers must now hold their investments for 3 years, rather than the standard 1 year, to qualify for those highly favorable long-term capital gains tax rates on their carried interest.
And the memo notes that Section 161 applies to both LPs and LLCs equally, right?
In principle, yes. The statute applies to all pass-through entities. But as a practical and doctrinal matter, the entirety of carried interest jurisprudence, decades of IRS revenue procedures, highly complex structuring workarounds to meet that new 3-year holding period, and foundational case law were all built conceptually and linguistically around the limited partnership framework.
I see.
The LP form remains the infinitely more comfortable, well-tested, and reliable platform for executing the carried interest strategy. Wall Street is not going to gamble its primary wealth creation engine on a newer entity structure just to appear modern.
It all comes back to the well-worn path. Risk aversion disguised as tradition.
Precisely.
So let's summarize this incredible journey we've been on through the Kutuzov Memorandum. We started our deep dive by looking at the historical evolution of businesses.
From the very beginning.
Right. We saw the terrifying joint and several liability of the general partnership, and we saw how the LLC emerged as the ultimate, flawless endpoint of corporate evolution.
The bumper car.
For Main Street, for the corner coffee shop and the tech startup, the LLC is the perfect padded bumper car. It decoupled management from liability, allowing everyday entrepreneurs to run their businesses without risking their personal ruin.
But then we crossed the border into the realm of elite private funds.
And we discovered that the LLC's greatest strength, its structural flexibility, is its fatal flaw on Wall Street. The limited partnership survives and utterly dominates precisely because of its rigid, inflexible constraints.
Its statutory rigidity creates a force field that protects passive institutional investors from triggering catastrophic regulatory ruin under the Volcker rule and ERISA.
Its bright-line distinctions shield those passive investors from the brutal 15.3% SECA tax that the IRS aggressively tries to pin on flexible LLC members.
And its deep well of Delaware case law provides absolute predictability for managers looking to eliminate fiduciary duties.
Not to mention its perfect alignment with offshore Cayman structures, which allows for seamless global fundraising without triggering double taxation traps in countries like Canada.
And of course, the one true historical vulnerability of the LP, the unlimited personal exposure of the general partner, was completely neutralized decades ago by the master hack.
Simply nesting a single-purpose LLC inside the GP slot to absorb all the liability.
Exactly. The modern limited partnership complex delivers all the physical protection of the LLC while offering a degree of regulatory certainty, tax efficiency, and global standardization that the LLC simply cannot match.
It is a brilliant, emergent architecture. It's like discovering that a Formula One car is actually powered by a heavily modified steam engine just because it's the only engine that doesn't trigger the track's radar sensors. It's fascinating.
It is fascinating. But I want to leave you with a final thought to ponder, looking past the Kutuzov memo and into the future of this architecture.
Okay, what's the thought?
We talked earlier about the Sorobin case, right? Where the IRS is starting to look past the legal label of limited partner to see what the person's actually doing in order to demand self-employment taxes.
Right, the functional analysis.
Exactly. This forces a massive question for you to ponder. If the IRS and other regulators eventually stop respecting the statutory wall of the LP and start applying functional reality-based tests across the board, will the LP lose its ultimate superpower?
Oh, wow.
Could the sheer aggression of tax authorities eventually force Wall Street to abandon the LP and invent an entirely new pass-through entity 3.0?
An entirely new entity. That is a wild, highly disruptive possibility to imagine. Finance always finds a way to optimize, and maybe the next evolution is just around the corner. Thank you so much for joining us on this deep dive into the hidden plumbing of the global economy. Keep questioning the structures around you, and we will see you next time.